What if building serious wealth didn't require stock picking, constant monitoring, or predicting the next market crash? What if it came down to just four numbers? 7, 5, 3, 1. The 7-5-3-1 investing rule is a simple behavioral framework designed to help SIP investors build long-term wealth without panic, guesswork, or emotional mistakes. In this video, you'll learn why 7 years can change your returns dramatically, how 5 categories reduce risk, the 3 emotional traps that destroy portfolios, and the 1 annual habit that quietly multiplies your final corpus. By the end, you'll know exactly how to apply this rule to your own investments. Now let's break it down. Please like, subscribe, turn on notifications, and comment the next video topic in the comments. Let me ask you something. If you planted a mango tree today, would you dig it up next year because it didn't produce fruit yet? Of course not. But that's exactly how most people treat their equity mutual fund investments. They start a SIP. They feel motivated. They're consistent for a few months. Then they begin checking returns. If the market goes up, they're excited. If it goes down, they're worried. If it goes nowhere, they're bored. And boredom is dangerous in investing. The first number in the 7-5-3-1 rule is 7. 7 years minimum. Not 5. Not 3. 7. Why 7? Because equity markets move in cycles. Economic expansions, slowdowns, recoveries, corrections. These cycles rarely align with your one-year expectations. In 1 year, markets can be wildly unpredictable. In 3 years, you might still be stuck in the middle of a downturn. But historically, as investment duration increases, the probability of positive returns improves significantly. 7 years gives you enough runway to pass through multiple phases of the market. Let's think about what typically happens inside those 7 years. Year 1 feels exciting. You're just getting started. Year 2 tests your patience. Year 3 introduces doubt if returns are flat. Year 4 might bring volatility. Year 5 might bring a rally. Year 6 might bring another correction. Year 7 is where you finally start seeing the pattern. You realize something powerful. Markets fluctuate, but long-term growth trends upward over time because businesses grow, economies expand, and productivity increases. Compounding needs time to breathe. If you interrupt it too early, you kill the process. Here's something most investors misunderstand. Compounding is slow at the beginning. The first few years feel insignificant. The numbers don't look dramatic. Growth seems small. But compounding is like a snowball rolling downhill. It starts small, then gradually builds mass. The biggest jumps in your portfolio usually happen in later years, not the early ones. When people quit in year 3 or 4, they often walk away just before momentum builds. And there's another psychological benefit to committing to 7 years from day one. It filters out noise. If you tell yourself, this money is locked for 7 years, daily headlines lose power over you. Market crash? You still have years ahead. Election results? You still have years ahead. Short-term volatility becomes background noise instead of a reason to panic. The 7-year rule is not about predicting returns. It's about building patience into your strategy. Because without a time commitment, even the best portfolio structure collapses under emotional pressure. But here's where things get interesting. Even if you commit to 7 years, you can still sabotage yourself if your portfolio structure is weak. Time alone cannot save poor diversification. And that brings us to the next number in the framework. 5. In the next chapter, we'll break down why spreading your SIP across 5 distinct categories creates balance, reduces regret, and dramatically increases your ability to stay invested when one part of the market underperforms. Now that you've committed to 7 years, we need to talk about structure. Because time without structure is just waiting. The second number in the 7-5-3-1 rule is 5. 5 categories. Not 5 random funds. Not 5 versions of the same strategy. 5 distinct segments of the market that behave differently over time. Here's why this matters. One of the biggest emotional triggers in investing is regret. Regret when you see another category outperform yours. Regret when your chosen fund underperforms. Regret when someone says, you should have invested there instead. Diversification is not just about reducing financial risk. It's about reducing psychological regret. Let's break this down. Large-cap funds typically invest in well-established, stable companies. These businesses are often leaders in their industries. They tend to fall less sharply during major crashes compared to smaller companies. but they may not grow explosively during bull markets. Mid-cap funds sit in the middle. They offer a balance between stability and growth. They can outperform large caps during economic expansions, but may experience sharper corrections. Small-cap funds often represent emerging, high-growth companies. They can deliver strong returns in bullish cycles, but they can also be extremely volatile when conditions turn negative. International or global funds add another layer. Instead of depending entirely on one country's economy, you gain exposure to global growth. If domestic markets struggle while international markets perform well, your portfolio stays balanced. Sector or value-focused funds add tactical exposure. Certain sectors outperform during specific economic phases. Technology during innovation cycles. Energy during commodity booms. Value strategies during market corrections. Each category has a role. The key idea is this: no single category wins every year. And that's exactly why you need multiple ones. When one segment underperforms, another may outperform. This natural rotation smooths the overall portfolio journey. Think of it like a 5-engine aircraft. If one engine slows down, the others keep you flying. But here's the part most investors misunderstand. Diversification doesn't eliminate volatility. There will still be fluctuations. There will still be months when everything feels slow. But diversification reduces the severity of extreme outcomes. Instead of experiencing dramatic highs and crushing lows from a single concentrated bet, you experience a more balanced trajectory. And that balance directly supports your 7-year commitment. Because the smoother your ride, the easier it is to stay invested. But even with time and diversification on your side, there is still one force that can destroy your long-term wealth faster than any market crash: your own emotions. And that's exactly what the next chapter is about. Because if you don't prepare for the 3 emotional phases ahead, even the best portfolio structure won't survive. You can have 7 years. You can have 5 categories. And you can still fail. Because the biggest risk in investing is not the market. It's your reaction to the market. The third number in the 7-5-3-1 rule is 3. 3 emotional phases that every long-term investor will experience. Not might experience. Will experience. If you stay invested long enough, these phases are guaranteed. Let's walk through them carefully, because recognizing them in advance is what gives you an advantage. The first phase is disappointment. This is the quiet phase, the subtle one. Your portfolio is not losing money. It's growing, but not at the speed you imagined. Maybe returns are in the 7 to 10% range. Positive, but not exciting. You expected faster growth. You saw someone online claim they made 30% in a year. You start comparing. Comparison is the beginning of dissatisfaction. Disappointment is dangerous because it tempts you to abandon discipline for excitement. You begin thinking about switching funds, chasing trends, moving into whatever performed best recently. But investing doesn't reward impatience. It rewards consistency. Then comes the second phase, frustration. This one feels heavier. The market moves sideways. Months go by, sometimes even a couple of years. Returns hover between 0 and 7%. You're investing regularly. Your SIP is running, but your portfolio feels stuck. You question your strategy. You question diversification. You question whether equity investing even works. Frustration is where many investors stop their SIPs quietly, not because of fear, but because of fatigue. They lose belief. But sideways markets are part of long-term investing. They are periods where the market digests previous gains. They are pauses, not endings. And then comes the most intense phase. Panic. Markets fall sharply. News channels amplify fear. Headlines predict recessions. Economic uncertainty dominates conversation. Your portfolio turns negative. Not slightly negative. Deep red. This is when your brain shifts into survival mode. It tells you to stop the pain, to exit, to protect what's left. And this is where most wealth destruction happens. Because when you stop your SIP during a crash, you stop buying at lower prices. When you redeem during panic, you lock in losses. Here's the irony. The periods that feel the worst emotionally often create the biggest long-term opportunities. Continuing your SIP during downturns allows you to accumulate more units at lower prices. When recovery begins, those units compound faster. But none of that matters if you quit. The 7-5-3-1 rule doesn't pretend these emotions won't exist. It prepares you for them. When disappointment shows up, you recognize it. When frustration hits, you label it. When panic strikes, you expect it. And when you expect something, it loses power over you. Emotional awareness turns reaction into discipline. Now think about what we've built so far. 7 years gives time. 5 categories provide structure. 3 emotional phases build resilience. But there's still one final lever in this framework that quietly multiplies everything. Because surviving volatility is powerful, but accelerating growth intentionally, that's transformative. And that's where the final number comes in. Now we come to the final number. 1. One step up every year. This might sound small compared to everything we've discussed. After all, 7 years is a big commitment. 5 categories require planning. 3 emotional phases demand mental strength. But this final one is the quiet multiplier. And it's the part most investors ignore. Let's start with a simple truth. Your income will likely grow over time. Not every year perfectly, not always predictably, but over a decade, most careers trend upward. Skills improve. Experience compounds. Earnings rise. But here's what usually doesn't rise. Your SIP amount. Many people start investing with a fixed number and never change it. They might invest the same amount for 10 or 15 years. On the surface, that feels disciplined. But in reality, it's stagnant. Because inflation doesn't stay stagnant. Lifestyle expenses don't stay stagnant. Your earning potential doesn't stay stagnant. So why should your investments? The one-step-up rule simply means increasing your SIP contribution at least once every year, even by 5 or 10%. It sounds modest, but over time, it becomes powerful. Here's why. When you increase your SIP annually, you're not just compounding returns. You're compounding contributions. In the early years, your portfolio grows slowly because the invested base is small. But as your contributions rise year after year, the capital working for you expands dramatically. The later years of investing often create the largest absolute growth because you're investing more money and that money is compounding. Think about it this way. If you invest a fixed amount for 15 years, your total invested capital grows linearly. But if you increase your investment every year, your capital growth becomes exponential. Small increases stack on top of previous increases. And here's something even more important. The annual step-up forces lifestyle discipline. Instead of allowing every salary raise to fully inflate your spending, you allocate a portion of that growth to your future. You pay your future self first. This habit changes your financial trajectory more than any attempt to time the market ever could. There's also a psychological benefit. When markets fall and you're increasing your SIP, you are automatically investing more money at lower prices. You're leaning into volatility instead of running from it. That's powerful. Now imagine combining everything we've built. You commit to 7 years, so you don't quit early. You diversify across 5 categories, so you reduce concentration risk. You prepare for 3 emotional storms, so you don't panic. And you increase your SIP once every year, so your wealth-building engine grows stronger with time. This is no longer just investing. It's a system, and systems beat emotion. But before we close, we need to zoom out one final time. Because the true strength of the 7-5-3-1 rule isn't in the numbers themselves. It's in what those numbers train you to become. Don't forget to subscribe on your way out. See you next video.